Welcome to this deep dive. Today, we're really getting into a critical document. It's Executive Order 14178, signed January 23, 2025, titled Strengthening American Leadership in Digital Financial Technology. Sounds important.
Oh, it absolutely is. And our mission for you, the listener, is really to get past the headlines, maybe the political noise. We want to look at the actual mechanics of this executive order. What does the text say? We're using the official document, the Federal Register info, all that source material. We need to figure out what exactly this administration has, well, torn down, what it's flat out forbidden, and the new path it's trying to carve out for digital assets.
It really does feel like a huge pivot, a totally new direction from the government. So let's jump right in. You said it's both destructive and constructive.
Yeah, that's a good way to put it. The core action, right, it's twofold. Revocation, clearing out the old, and then prohibition, drawing a hard line. So starting with those revocations, the order immediately wipes away two previous policy pillars.
Okay, what are we talking about? Which two?
Well, first, there's Executive Order 12067. That was from back in March 2022. And its focus was ensuring responsible development of digital assets.
Responsible development. Sounds, reasonable on the surface, so why get rid of it completely? Was the old way just not working, or is this more like a fundamental disagreement with the whole approach?
I think it's definitely the latter. A philosophical rejection, really. That previous order, it basically told agencies to, well, look into potential upsides, but mostly focus on the risks. And a big part of that was exploring a U.S. Central Bank Digital Currency, a CBDC. So by revoking it, this new EO is signaling, look, we're done exploring that specific path. We're shifting away from that risk-first mindset towards actively promoting something else.
Okay, that makes sense. And the second revocation, that sounded like it affects how the U.S. deals with other countries.
Exactly. The second thing tossed out is the Treasury Department's Framework for International Engagement on Digital Assets. That came out in July 2022. Getting rid of this is a pretty big signal internationally. It basically says the old playbook for working with other countries on digital assets gone, replaced by, well, something new, presumably centered on U.S. leadership with private sector stablecoins.
Right, which sets up the really big, bold move here, the CBDC prohibition.
Yes. This is probably the most striking part, Section 5. It's crystal clear. Federal agencies are, and I quote, strictly prohibited from undertaking any action. And the language is super broad. Any action to establish, issue, circulate, or promote central bank digital currencies. And that's not just in the U.S. It applies to what agencies do overseas, too.
Wow. So any government research into a digital dollar just stops cold. Yeah. And maybe for you listening, just to be precise, what is a CBDC according to this order? What makes it so concerning to this administration?
Yeah, the definition is crucial here. It defines a CBDC as digital money denominated in the national unit of account. So dollars. That is a direct liability of the central bank. That's the key phrase.
Direct liability of the central bank. Okay, unpack that. Why is that specific phrase so loaded?
Because it changes the fundamental plumbing of the financial system, you see. If your digital dollar is a direct liability of the Fed, it means the Fed is essentially your bank account provider for that money. It potentially bypasses conventional banks for everyday transactions. And for people focused on economic liberty, which is the explicit philosophy in this EO, that degree of central control, that visibility the government could have, putting the central bank right between you and your money, well, that's seen as a major threat, a threat to privacy, to financial freedom.
So it's really rooted in a deep opposition to that kind of centralized government power over money. And the order makes it clear any ongoing work, any projects looking into a U.S. CBDC, they have to stop immediately.
Immediately. Full stop. No more pilot programs, no more internal studies, no more talking it up internationally. It's done.
Okay, so that covers the what. Let's shift to the why. Because the EO doesn't just ban things, it really lays out an ethical case, doesn't it? It connects policy directly to people. The administration says the goal is promoting U.S. leadership while, quote, protecting economic liberty. What does that phrase actually mean in practice here?
In this context, it means supporting the growth of private digital assets responsibly, while shielding citizens from what it sees as the specific dangers of CBDCs. The order literally says CBDCs threaten financial stability, individual privacy, and even U.S. sovereignty. So economic liberty here really means favoring decentralized private solutions over government-controlled ones.
And you see that philosophy baked right into the specific policies listed in Section 1, like the first one. Promoting the ability for regular people and private companies to use open public blockchains, lawfully, of course, but without persecution.
Right. And this is where the EO gets quite granular about supporting the actual tech.
Hmm.
It specifically mentions protecting the right to, develop software for these networks, run mining or validating nodes, transact without someone unlawfully censoring you. And this is huge, Kennedy. Maintain self-custody of your digital assets.
Self-custody, that term keeps coming up. It basically means you hold your own keys, right? You control your funds directly, and no bank or intermediary needed. But why does an executive order need to explicitly endorse that? Isn't that just how crypto works for many people already?
It is how it can work, but self-custody has been facing, let's say, regulatory headwinds globally. Often past discussions framed it as a potential risk,
Hmm.
for money laundering or illicit finance. So by actively promoting it, the administration is drawing a line in the sand. It's saying, we see self-custody not as a problem to be regulated away, but as a fundamental aspect of economic freedom that deserves a protection from the very top.
That's actually quite a statement for an official government document. Wow, okay, moving on from individual control, it also talks about traditional finance, right? Access to banking.
Yes, it commits to protecting and promoting, quote, fair and open access to banking services for all law-abiding citizens and private businesses. This seems aimed squarely at what the industry calls de-risking, where banks are hesitant or outright refuse to serve crypto companies because the rules aren't clear. This policy signals, hey, legitimate crypto businesses shouldn't be unfairly locked out of basic banking.
And finally, on the policy front, the order makes a clear choice about the future of the digital dollar, doesn't it? It's betting on stablecoins.
It absolutely is. It promotes the growth of lawful and legitimate dollar-backed stablecoins globally. This is clearly their preferred path forward. The EO basically positions well-regulated, private sector stablecoins backed by dollars as the way to keep the U.S. dollar dominant in the digital age. Let the private sector innovate, essentially, rather than building a government digital dollar. It's a very deliberate choice.
Okay, so the order doesn't just, clear the decks and state a philosophy. It actually starts building the new machinery. Section 4 sets up this president's working group on digital asset markets.
Right, housed within the National Economic Council. And this group is clearly meant to be the engine for whatever comes next. And just look at who's in it. That tells you a lot about how seriously they're taking this.
He's on the list.
Well, it's chaired by the Special Advisor for AI and Crypto, but the members include the Treasury Secretary, the Attorney General, the Head of Homeland Security, and importantly, the chairs of both the SEC and the CFTC.
Wow. So you've got finance, law enforcement, national security, and the two key market regulators all at the same table. That seems designed to maybe prevent the usual infighting between agencies that can slow things down.
That seems to be the goal, yes. Centralized, decisive action, and they are put on a very tight schedule to deliver clarity. The clock started ticking the moment the order was signed back in January 2025.
Okay, let's talk about that timeline. What has to happen and when?
Well, first, within just 30 days of the order, all the agencies in that working group had to basically do an inventory. Identify every existing rule, guidance, order, anything that touches the digital asset sector. That's a fast audit.
30 days is quick just to find everything. And then what?
Then, right after that, within 60 days total from the order signing, they had to recommend what to do with all that stuff. Should these old rules be scrapped, changed, kept? It's basically a rapid cleanup of existing potentially conflicting policies.
So a 2-month blitz to clear out the clutter? But the main event is later, right? The big report.
Exactly. The main deadline is 180 days from signing, so roughly 6 months. By then, the working group has to give the president a full report with recommendations for a whole new structure.
And that 180-day report needs to deliver on two major things, based on the text. First, a comprehensive federal regulatory framework.
Yes, a framework for how digital assets, including stablecoins, are issued and operate. It needs to cover market structure, oversight, crucially, consumer protection, and risk management. And the order specifically says these rules need to be technology neutral. Focus on the activity, the risk, not, whether it's Bitcoin or something else.
Okay, tech neutral framework. And the second deliverable, this one really jumped out at me when I read it. It sounds a bit unusual. Evaluating the creation of a national digital asset stockpile. What on earth is that?
It is unusual. It's basically like a strategic reserve, like the Strategic Petroleum Reserve, but for crypto. The order suggests this stockpile could potentially be built up from cryptocurrencies the government seizes legally, through law enforcement actions, asset forfeitures.
Huh. So instead of the government auctioning off seized Bitcoin or whatever right away, like they usually do, they might just hold on to it. The U.S. government could become a long-term HO dealer, basically. What would be the point of that?
Well, there could be a few angles. First, it suggests the government might see these assets as having some kind of strategic value, maybe like digital gold. Second, depending on how much they hold, managing this stockpile could potentially, maybe indirectly, influence the market for those assets. It's also a way for the government to gain exposure to crypto without actually spending taxpayer money or explicitly endorsing any specific coin. They're just keeping what they take from criminals. That's definitely a novel idea in an EO.
It really is. Okay, so let's try to wrap this all up. What does this deep dive into EO 14178 really mean for you, the listener? Well, we've seen a clear, decisive shift. The government exploring a CBDC, that's over, banned. Instead, the priority is boosting private digital assets, especially dollar-backed stablecoins. And there's this powerful working group tasked with creating a whole new rulebook, technology neutral, in just 6 months.
Yeah, I think it's important to see this EO as more than just rules. It's really laying down a philosophical marker. It anchors future regulation in this idea of supporting open networks, supporting self-custody, and prioritizing individual economic liberty in this digital realm. It elevates digital assets from just being about financial risk to being potentially a strategic part of U.S. economic policy and sovereignty.
And that philosophical grounding brings us to a final thought, something for you to consider. The order explicitly says the new framework must ensure consumer protection right alongside that primary goal of economic liberty. So the big question is, how will this working group actually balance those two things? How do you protect consumers in a world of decentralized finance and self-custody, where the whole point is individual control and responsibility, often without the usual safety nets? Balancing that inherent risk of freedom with the need for real safeguards. That tension right there, that's likely going to define the next chapter of crypto regulation in the U.S.